After a strong employment report in January, the yield on the two-year Treasury note posted its biggest one-day rise since March 2020. The two-year Treasury yield notched its biggest one-day climb in almost 2 years, plus its seventh straight week of gains. On Friday, after January's non-farm payroll report showed a stronger-than-expected gain of 467,000 along with big upward revisions for the prior 2 months. What are yields doing? The two-year Treasury note yield BX MUB-MUST 02Y climbed 13.2 basis points to 1.322%. Up from 1.19% on Thursday afternoon. That's the largest one-day gain since the 10th of March 2020. For the week, the rate was up 15.2 basis points for its seventh straight week of gain. The yield on the 10-year Treasury note MUB-MUST 10Y 1.913% rose 10.5 basis points to 1.930%. Up from 1.825% at 3 p.m. Eastern on Thursday. Yields and debt prices move opposite each other. The 30-year Treasury bond MUB-MUST 30Y 2.213% was up 8.8 basis points at 2.232% versus 2.144% late Thursday. For the week, the 10-year rose 15.1 basis points while the 30-year climbed 14.9 basis points, the largest one-week gain since the period that ended January the 7th. According to Dow Jones market data. What's driving the market? Data released Friday showed that the U.S. gained a healthy 467,000 jobs in January, and hiring was much stronger at the end of 2021 than originally reported, suggesting businesses did better at filling openings despite the Omicron variant wave of COVID-19. Economists polled by Wall Street had forecast 150,000 new jobs, and many investors were even bracing for the first contraction in employment since December 2020 because so many workers were ill last month. The government also revised figures for the end of last year, with the U.S. adding 510,000 jobs in December instead of 199,000, and employment rose by 647,000 in November compared with the prior estimate of 249,000. Meanwhile, the unemployment rate rose to 4% from 3.9%, while hourly wages rose 23 cents, or 0.7%, to $31.63 in January. After Friday's labor report, the likelihood of a half-point rate hike in March by the Fed went up to almost 35% Friday afternoon from 14% on Thursday, according to the CME FedWatch tool. Investors now turn their attention to next week's Consumer Price Index report. Read what a strong January jobs report really means for Fed's March rate hike. What are analysts saying? All else equal, this better-than-expected jobs report for January likely hardens the Fed's resolve to begin raising interest rates at its next meeting in March, in an effort to bring under control the other half of its dual mandate, said Jason Pride, Chief Investment Officer of Private Wealth at Glenmead. The 467,000 gain in non-farm payrolls in January is even stronger than it looks, as it came despite the spike in absenteeism driven by the Omicron virus wave and was accompanied by significant upward revisions to the gains over the preceding month. That will further fuel expectations of the Fed unleashing a 50 BP hike in March, said Andrew Hunter, senior U.S. economist at Capital Economics.